Good afternoon, everyone, and delighted to be hosting another webinar for the members on improving your financial literacy, really. And this is something we've had a lot of feedback around since we started our partnership with the Law Society. I know a lot of members are really keen to increase their knowledge around how they manage their investments and their wealth generally. So really pleased that we can offer out these sessions. I think they're really helpful. For those that don't know who JMFin are, we're a personalised, we offer a personalised wealth and investment management service to about 18,500 clients across the UK and a few overseas. We have 6 offices across the country, and we run about £11.5 billion pounds worth of assets under management for those clients. I work in our Bristol office. We've been set up for about 20 years. JMFin has been running for about 80. So we're a very established office with 11 investment managers. If you don't know me, you might know one of my colleagues in the office. So yes, we've been running a number of educational events already. Those are recorded and available online through the Bristol Law Society. So if you haven't already watched those and you're interested, then go and check those out. We also have a number of resources I'll mention, which are available on our own website. So if you want any information about anything we've covered today or generally, then do have a look at our website, because there's some really useful resource pieces on there. We are also offering financial surgeries for any members that have any burning questions that are more specific to their situation. We've got a number of sessions running tomorrow, and if you want to come along to our office, we have a few sessions still available. We will be looking to roll those out online later in the year as well. So once we have dates for those, we will communicate that out to Bristol Law Society members, and you can book through them. So without further ado, I just think it's an opportunity to introduce now John Cunliffe, who is our head of our investment office, to talk about what's happened in the stock market over the last year, what's happening at the moment, what we think is going to happen in the year ahead. Great way to kick off a new financial regime for the new year. So I will hand over to John, and he will give you some insights into what's happening in the stock markets now. Thank you.
Brilliant, and thanks for a really good introduction. Can we have the first slide, please? Next one. And the next one. I don't think you want to dwell on me too much, but that is me. Right. Okay. I think going back to the beginning, there's a tendency, I think, in markets for people to focus on geopolitics. There's a fractured lens at the moment that people are looking through to view the world, and it's geopolitics. And clearly we have a lot of uncertainty around that. We used to have a relatively predictable rules-based world order, which seems to be in the process of being eroded. We've now got a bipolar world with 2 groups of countries, one under the US and one under China, with Russia as a potential interloper. And obviously we've got the weaponization of trade policy as well from the US administration to try and achieve its ends. Now all of this, I think, is very much noise. And it's our job really as investors to try and distinguish signal, which is more important, from noise. So there's a number of elements, if you like, on this first slide, which I could quickly run you through. And these are typically the major drivers of markets, particularly equity markets, over a 6 to 18 month time horizon. So I'd call that really a cyclical time horizon. And the first one we have is global liquidity. The global liquidity cycle, which is essentially broad money growth, has been accelerating at a pace more rapidly than global nominal GDP. And when that happens, that tends to be a supportive backdrop for risk assets. In particular, the fact the US dollar has been quite weak over the last 12 months has also been good, because it tends to boost the dollar value of non-US money growth, which has been particularly strong in China, for example. So strong liquidity growth is generally good for markets. The next element is central bank policy. are central banks putting rates up or putting rates down? As an ex-central banker myself, I do understand the link between interest rates and market appetite for risk, if you like. And we do anticipate in the US in particular an overhaul of the US Federal Reserve, engineered by hook or by crook by Donald Trump. And that will mean that we'll have probably lower interest rates than is currently expected by financial markets. In the UK, we think the labour market is quite weak. We also think inflation, once we get through April this year, will be quite soft as well. And I think there'll be ample scope for the Bank of England to cut rates by more than is currently expected, certainly down towards 3% by the end of the year. And then in Europe, you've got a European Central Bank, which is still keeping policy relatively supportive, but could certainly cut interest rates by more, with inflation staying pretty low and the euro quite strong. In the emerging world, again, we're seeing rates coming down as well, with the backdrop of a weaker dollar and lower inflation in their economies providing cover to lower rates. And I think the one potential fly in the ointment is the Bank of Japan. In Japan, we have very low interest rates and we have quite a pickup in inflation and also wage growth. And really, for the first time in 2 decades, self-sustaining recovery. And I think the Japanese authorities want to try and boost the economy via government spending, but also keep rates down. And there's a little bit of a tension there. And we've seen a bout of interest rate volatility in terms of the Japanese bond market over the last couple of days reflecting that. But in general, what we're saying is central bank policy will generally be a favourable backdrop, I think, for equity performance. Fiscal policy, again, that seems to be generally positive. We've got Trump's self-proclaimed One Big Beautiful Bill Act, which was put into train last year. We've also got unprecedented German-led fiscal stimulus in the Eurozone around infrastructure and also defence. And also a little bit of front-loaded fiscal stimulus in the UK, but backloaded tightening ahead of the next election, whenever that is. But in general, we think policy is really aligned both monetarily and also in terms of fiscal policy towards what we call reflation, which should be broadly supportive for equities. Economic growth, it's been pretty mixed over the last year, but certainly the global economy seems to be holding up rather better than was feared in the immediate aftermath of the Trump announcement on tariffs last April. Inflation has been disappointing over the last few years in terms of being above target, but it's nonetheless been surprising on the downside, particularly in the US. I might be a bit skeptical as to whether those US inflation numbers are truly correct, now that a third of the basket is now estimated by the Bureau of Labour Statistics. If I worked there and wanted to keep my job, I know which way I'd estimate the inflation numbers, but nonetheless, we have had generally weaker than expected inflation numbers, even if they have been a bit higher than central banks would have wanted. Corporate earnings delivery has been strong in the US, but there's evidence now that it's broadening out, both by region and sector. And again, that's helpful, I think, from an equity perspective. And the one thing that is a little bit troubling within this kind of scorecard approach is the uniformly bullish sentiment I think there is in the market to equities for this year, really reflecting positioning, Wall Street estimates, which are 21 out of 21 for higher prices. And I think that's something to keep an eye on, particularly if markets get to a more euphoric level. But really taking this framework and trying to sort of put the geopolitics to one side for the time being, this is a favourable backdrop, I think, as we start the year for equity investing. Next slide, please. Okay, this chart goes back to the Second World War. It's on what's called a log scale, so it normalizes the trend. The red line is the S&P 500, which is the US large cap equity market. And the blue line is all economy profits in the US. And I think what this shows is that if there's one thing about the past we'd like to change or wish we could change, it's that we worried less about the future. Because this tells you really, despite all the post-war tectonic shifting, if you like, in terms of the geopolitical plates, the Cold War, We had the dot-com crash in the late 90s. We had the 1970s energy price spike. We had the GFC in 2008. Throughout this whole period, despite the obvious concerns investors would have had in terms of geopolitics, equities went up in price and so did corporate profits. Now, you know, we are a little bit, shall we say, heading into the territory where there's a bit of a disconnect between the level of the US equity market and the level of all economy corporate profits. But you can see from this chart, if you reference back to 1999, that disconnect is nowhere near as great. And if you take the mega cap US equities, there's certainly some very strong free cash flow generation. So this is kind of flashing amber from a cyclical time horizon, but it's certainly not a reason not to expect further gains this year. Next slide, please. Now, this chart, if you take a 10-year view, I think is a little bit more concerning, and I'd be remiss not to bring it in. So along the bottom axis, we've got the price to earnings ratio of the S&P based on next year's earnings. And we're currently at 24.3 times 12 months earnings, which is actually quite a high multiple of earnings you're paying if you buy the stock market today. And on the left-hand axis heading down, you can see the subsequent 10-year returns. So this is telling you that over the next 10 years, certainly US equities are going to give you below average returns based upon today's starting valuation. Now, that's the reason why across our portfolios, we typically have a lower weight to the US than the market cap of the global equity market would suggest. But also, it doesn't tell you what's going to happen over the next 12 to 18 to 24 months, where we think based on that earlier scorecard, there's reasonable scope for optimism. But this is certainly telling you on a 10-year time horizon to be a little bit careful about having a full market weight to the US equity market. Next slide, please. Okay, so one of the reasons why we've got a problem in the global economy is because global growth really fell off trend after the global financial crisis in 2008. So that blue line is telling you that we had a fairly strong uptrend in nominal GDP, that includes inflation, really up until 2008. But then we had the financial crisis and it fell off trend badly. And the major reason for that, I think, was a combination of caution on the part of the corporate sector, caution on the part of governments who cut spending quite aggressively, and also concerns from the household sector as well. So we had a kind of collective retrenchment, which actually made things worse. Everybody did what was rationally in their own interests, but the overall outcome in terms of the economy was a lot worse. And of course, that made dynamics in terms of debt or borrowing as a percent of GDP a lot worse. And now the goal does seem to be to boost nominal GDP, nominal growth, and effectively deflate away, government debt, if that's possible. Next slide, please. Okay, this is a noisy chart, but what I've taken in the US is the level of nominal GDP growth, and then I've subtracted from it the nominal budget deficit. So you can see there was a lot of volatility in that relationship in 2020 because of the pandemic and the shutdown. But really, although the fact remains that we've had reasonable nominal GDP growth over the last 2 to 3 years after the pandemic, typically the budget has still been greater than nominal GDP growth. So this is really showing that Trump in the US and Scott Bessent, his Treasury Secretary, are pulling all the levers they possibly can to try and outrun, if you like, the budget deficit by getting growth higher than the amount of borrowing in the economy. And that's one of the reasons why we've got what we think is a strongly reflationary impulse over this year ahead of the November midterm elections. Next slide, please. Okay, this is a chart for the UK. You can see the blue line, which is very similar to what it is in terms of the US. That's nominal GDP, again, falling off its perch, if you like, after the financial crisis. And we had a particularly bad outcome in the UK because collective retrenchment was also expressed via austerity, which ended up, I think, causing a much weaker growth profile than would otherwise have been the case. And certainly the UK economy went significantly off course, and we're probably 10 percentage points in terms of growth away from that trend line. And of course, the debt to GDP, which is the red line, which is currently at around 100% if you include all the bonds the Bank of England bought as part of its QE program, has really risen significantly post the GFC. And that is something that the Labour administration are very keen to addressing, to try and cause the economy to grow more rapidly, to try and deal with the overhang in terms of the debt burden. It's a challenge, but it's a similar challenge to that which presents itself to the US as well. Next slide, please. Okay, we've talked about nominal GDP and what it all means. If you believe that we're going to generate reasonable nominal GDP, that does align to fairly strong revenue growth. That red line shows the link between sales growth in the corporate sector and a nominal GDP. So, if we are bullish on nominal GDP, I think it's reasonable to expect that sales growth will be well supported. And if margins stay high, and they do seem to be quite high, notwithstanding the effect of tariffs, that suggests that pricing power could actually support corporate earnings delivery via the bottom line as well. So this is actually a good chart from an equity perspective, showing that nominal GDP and sales growth do align. Next slide, please. Okay, populism. We can't really have a conversation about markets without talking about populism. This chart, the blue line, shows that labour income in the US as a percent of GDP, as a proportion of the economy, has fallen from 47 to 42%. Over the same time horizon, which is 25 years, when China was first brought into the World Trade Organization, you can see that tax as a proportion of after-tax corporate profits as a proportion of GDP have more than doubled from just under 6% to around 11%, 12% now. Now, that's a big shift away from Labour towards capital. And certainly Trump, in his early time last year as president, was certainly talking very much in terms of boosting Main Street over Wall Street. I think, unfortunately, the immediate aftermath of his initial tariff announcements have caused him to pivot back to supporting Wall Street. And unfortunately, although people are very angry about this chart because it shows that Labour is missing out in terms of its reward, I think we're really going to see more of the same. And that's just going to fuel some even more populist pivots from policymakers, which may not necessarily address the issue, but will be quite performative. Next chart, please. Okay, so we've talked briefly about tariffs at the start. US tariffs, well, they're higher than were hoped initially, but they turned out to be not as high as feared. The effective tariff rate has gone from about 2.5% to about just under 11% now. Now, clearly, the latest skirmish on tariffs is all around Greenland, with the threat that we could see tariffs of an additional 10% on 8 countries, including the UK, from early February, and then another 15% on top of that in June. We think it's probably a negotiating tactic, and also somewhat more unhelpful from the Trump administration's perspective. These tariffs have been levied under the Emergency Economic Powers Act, which may not be legitimate. So it's quite possible this week they get struck down. But this new thing in terms of US policy, weaponizing trade policy for its sort of economic and geopolitical ends, is certainly a new thing. And it's something that really is giving rise to elevated policy uncertainty. But we're only really focusing on this if it has an effect on the 7 factors that we announced at the start, or outlined at the start. This in isolation doesn't feed through into equity market outcomes unless it affects things like liquidity, central bank policy, fiscal policy thrust, earnings delivery, and so on. So anyway, that's very much up in the air at the moment. We are a little suspicious about the US inflation data against this backdrop, because inflation has typically been somewhat weaker than expected, with margins still quite high. But we give it the benefit of the doubt because it certainly suits the Trump administration's reflationary posture. So next slide, please. People have talked about bubbles, and this is private fixed investment in IT and software as a percent of GDP, and you can see that it's risen back up to levels that we last saw in the dot-com era. But I think what we would say is that a lot of this AI-related investment has taken place over the last couple of years. So that move up really hasn't been anywhere near as steep as we had in the late 90s. So we tend to think this as being something to worry about, but not a reason to think that this capex cycle is about to go in reverse and take markets with it. So next slide, please. Okay, this is a challenge for everybody. I've got two sort of time series here. The blue one is the S&P 500, which is taking the market cap weights of all the individual constituents. And the red one is assuming that you just weight all the constituents the same. Now, what's happened is that returns have been increasingly concentrated so that the market cap weighted S&P 500 has significantly outperformed the equally weighted one. And that's been a challenging environment for active investors who typically hold equities on an equally weighted basis. Next slide, please. And the result of that has been, as you can see here, what we call rising market concentration. So you can see from 2015, the proportion of the S&P 500 made up of the top 10 stocks in terms of size has gone from 17% to just under 40%. And now Nvidia, Apple and Microsoft each now comprise a bigger proportion of the global equity market than the entire FTSE 100. So this is, again, a little bit of an amber flag when it comes to the US equity market because of concentration, but also just contextualizing how difficult it's been in terms of beating the market if you build portfolios on an equally weighted basis. Next slide, please. And then as a result of the previous two slides, you can see that the proportion of global equities made up by the US equity market has risen from about 50% just before the financial crisis to about 72% today. Now, over a shorter term time horizon, we think that's perfectly okay. But over a sort of 5 to 10 year time horizon, I think this does suggest that you need to have a greater degree of diversification outside of the US, because I think this is not sustainable. And if we're in a world now where the US administration is very, very keen over the medium to long term to get the dollar down in terms of its value, that is going to be a bit of a drag anchor in terms of US equity returns for the sterling-based investor. And I think also there is already evidence that international investors are looking to diversify away from the US, given what seems to be a pivot away from the traditional rules-based international order from the Trump administration. So again, absolutely fine to hold US equities to a high weight over the next 6 to 18 months. Beyond that, probably sensible to start considering reducing weights against this global equity allocation. Next slide, please. Okay, we identified 7 points at the start in terms of what's good for equities or maybe not so good. This is really showing the re-acceleration of money growth more rapidly than nominal GDP. And that's really been quite a big tailwind, I think, or supportive backdrop for risk. Typically, a big pickup in money growth, particularly in US dollar terms, does tend to support markets. And we've seen that really over the last year, driven by a weaker dollar, but also strong US money growth and strong Chinese money growth as well. So that's a favorable and reassuring chart. Next one, please. We mentioned the Bank of England and the US Federal Reserve and also the ECB and the Bank of Japan. We think the two lines at the top, the UK and the US, will probably end up seeing rates fall below those levels expected in the market. You can see there's modest rate cuts priced in there. The ECB, the European Central Bank, the green line, I think that that could also end up becoming a lower line. I think they could certainly consider cutting interest rates this year, reflecting the very strong euro and also inflation, which has been pretty well behaved. But the one that's really exercising the market at the moment is the purple line at the bottom, which is the Bank of Japan. Currently, rates are at 0.75%, expected to rise towards just above 1% over the next sort of 10 months. I think that's probably too low. I think the markets are telling the Bank of Japan, against the backdrop of quite a big budget deficit and inflation quite sticky, they'd like to see rates somewhat higher. Now, if that causes the yen suddenly to rally, that could shake out some speculative positions funded by the yen. So we are keeping an eye on that. But again, this is noise rather than signal. But just covering our own backs, if you like, to say that there is a source of volatility this year potentially coming out of Japan. But at the moment, it's not going to overrule, some of the positive signals that we're seeing. Next slide, please. Okay, this is a chart. Hopefully it become clear. We've got the last several US Federal Reserve, the US Central Bank rate cutting cycles, starting in 1984 and going to the most recent one at the bottom. What we've discovered is that if the US Federal Reserve is cutting interest rates to get them to what's called a more normal level, rather than to fight a market panic or a recession, you tend to get the best returns in the S&P 500. So the light green bars, if you look at those, every time the Fed has cut interest rates with a view to getting them to a more normal level rather than stave off a market panic or offset the effects of a recession, you get some pretty strong returns. And that's another reason why we think this particular rate cutting cycle from the US Federal Reserve, which we think will probably be a little bit more aggressive than is priced in, I think will be supportive for US equities over this cyclical time horizon. Next slide, please. Okay, so this is telling you that the economy is actually globally done all right. If you adjust it for purchasing power of each economy's currency, you can see that we really have had quite a resilient economic cycle, which is certainly at odds with the doom and gloom that we had in the immediate aftermath of Trump's tariff announcements last April. Next slide, please. And this is just a chart which shows the extent to which the market is being positively or negatively surprised by incoming economic data. So a level above zero says that you're getting more positive than negative economic surprises. And typically they have been pretty positive. So not only has the magnitude of growth generally been pretty good compared to expectations, it's actually been pretty good as well relative to what the market at real time was expecting. Next chart, please. The one thing that has really caught people off guard is what we call leading indicators. People in the financial markets and economists are always looking for, factors that you could identify which might give you some insight into where the economy is going. Now, the dark blue line or the dark blue shaded area is a leading indicator produced by the conference board. And what it shows is that when it rolls over quite significantly, you get what's called a recession. And the thickness of those orange bars, the recession bars, are to do with the duration, if you like, of the recession. So a thicker bar means a longer recession. And what's happened is that we typically, given the degree to which this leading indicator has rolled over, you typically normally see a recession. And I think the reason we haven't this time round is because global trade flows and the front loading of activity in anticipation of tariffs have really negated some of these signals. And it's certainly a reason why lots of investors in the bond market, in the equity market were caught, if you like, on the hop by what's actually happened in markets. And again, it just shows having our sort of 7 bullet points or 7 point scorecard approach that we had identified at the start is a slightly better approach than simply looking at things like traditional leading indicators for a sign where the real economy may be going at any point in time. So next slide, please. Again, this is a chart on inflation. It's weighted according to each individual country's contribution to global growth. And we've had a significant post-pandemic decline, but also we're at a level now where inflation is still above where central banks would like it to be. I think the broader conversation really is that, you know, in the world where China was first introduced into the WTO in the early noughties, we did have really quite a strong disinflationary pull from globalization. And I would tend to question in the world order we're now in whether having this desire to get inflation materially lower from current levels is actually desirable. I think central banks would certainly be quite happy to have a slightly higher inflation target. They're only concerned about signaling this because in the current environment, it might be viewed as a credibility issue for them. So, you know, inflation has certainly been falling quite significantly, and we think it will fall further this year, particularly in the UK after April. But, you know, it won't go back to levels on a sustained basis that we saw before the pandemic. Next slide, please. And this is just a measure of inflation surprise. Just as growth has been surprising on the upside, inflation has been surprising on the downside. And that's despite the imposition of tariffs, where ordinarily you would have thought that with high levels of margin, that would have been passed through onto consumers. It doesn't seem to have happened to the same extent. And for the time being, that's certainly helpful. A big shift up in terms of inflation surprise, certainly above zero, could give rise to a few concerns in the risk asset side, particularly equities. But for the time being, this is a reassuring chart. Next slide, please. We mentioned budget deficits on fiscal policy. The chart we have here in the blue line has the US budget deficit, which is currently just below 7%. And then what I've overlaid on an inverted scale is non-financial corporate profits on the right-hand axis in the US, which does tend to correlate quite strongly. So we would view deficit spending in the US as supportive of non-financial corporate profit delivery. And obviously more deficit spending this year under Trump's so-called One Big Beautiful Bill Act is going to be supportive, I think, of the profit cycle. Next slide, please. Corporate earnings we have here. The best corporate earnings delivery actually is the purple line, which is the Nikkei, the Japanese stock market. They've been re-accelerating quite strongly, and that's been quite a good tailwind for the Japanese equity market more broadly. The S&P 500 is kind of middle of the pack there, which is doing pretty well. You can see that it's been growing at around cumulatively 20% over the last couple of years or so. FTSE 250, which is the UK mid cap, has also been doing pretty well as well. It's been pretty volatile, but the two ones that stand out as being disappointing in terms of negative corporate profits growth are the European Euro Stocks 50 and the large cap UK FTSE 100. Next slide, please. And then positioning. Now, positioning is something I flagged at the outset as being a potential fly in the ointment. 21 Wall Street forecasters were bullish on equities this year and none were bearish. JP Morgan estimate that positioning is now in the 75th percentile. That's pretty high. And then there's a Bank of America survey, which has also got the highest level of optimism we've seen since July 21. So we need to be cognizant that people are starting the year in an optimistic frame of mind and that there could be some shakeout potentially if we get some bad news. Next slide, please. This just gives you some idea for equity returns for last year. The penultimate column is the one to focus on. You can see emerging markets, Asia, Japan, UK, Europe, and then the US at the bottom. Now, this hasn't been adjusted for currency, and the US dollar was around 8% weaker against the pound. So if you adjust that in terms of the US equity return, you can see that actually US only delivered about 10%. And we think that the US dollar is also vulnerable this year against further monetary experimentation from the US Federal Reserve, and that could be certainly eroding from US equity returns for a sterling-based investor. Next slide, please. Global equity sector returns have also been broadening out. So you can see here, based on global equity index, We've got materials, miners, and things like copper doing really well. Industrials benefiting from a kind of cyclical pickup in terms of the economy. Banks have done very well in the UK and also the US. Rates staying slightly higher than people had earlier expected, and yield curves being quite steep have certainly been positive there. So this is actually encouraging that returns by sector are a lot broader than they were, even if in the US, the so-called Magnificent Seven, the mega cap tech stocks have still been dominant. So I view this as a kind of constructive backdrop, I think, to having a more globally diversified equity allocation. Next slide, please. And then, we mentioned that returns were broadening out by sector. I think as far as the global equity market is concerned, this year will be a year where returns also broaden out by region. And you can see the US is still going to be, up in the towards the high end in terms of returns from earnings, but also emerging markets are going to benefit from the weaker dollar and also widening growth differentials between the EM world and the developed world. And Japan and UK also participating here. So again, if you're looking to build a diversified portfolio by region and also sector, this is a helpful chart to consider. Next one, please. This is really how we started out the conversation. You can see that valuations are stretched. The US against its 20-year average is probably the most expensive of all markets, with the UK against its 20-year average, the least expensive. Again, this doesn't really impact market performance over a 6 to 18-month time horizon, but over a 20-year time horizon or 10-year time horizon, as we started out, it does give rise to maybe a desire to hold a little bit less US than the market cap index would suggest. Next slide, please. And then in terms of narrative in the market, we've done our scorecard at the start where we've generally said that the factors driving returns are broadly supportive. There are some things to factor in as well. So we've got this so-called Monroe Doctrine in the US, which is Trump essentially saying that the Western Hemisphere belongs to the US and leave off. But that's really only going to deliver, we think at the moment, periodic bouts of volatility on this elevated regional geopolitical risk. We've said that policy now drives economic outcomes, and that's important because in the past, policy, I think, reflected economic outcomes. So if you understand where policy is heading, it gives you a better edge, if you like, to understand where markets will go. We do think, as we've already said, that a 2% inflation target is a bit too low, and it's probably not achievable or desirable on a sustained basis either. And I think markets are probably happy to go along with that, even if central banks are still paying lip service to a 2% inflation target. Donald Trump has made it clear that he wants what I would call a bullish market dovish regime change at the US Federal Reserve. And he certainly wants to use the Fed as a tool to boost markets ahead of the November midterm elections. Also very cognizant of the burgeoning borrowing cost in terms of interest rate expense and its effect on the budget deficit. So he's going to lean on whoever takes over from Jerome Powell, the current Federal Reserve chair, to keep policy on the easy side. We've mentioned that name of the game now, rather than cutting spending to shrink the deficit, it's boosting nominal GDP. And that's certainly supportive in terms of the near-term outlook in terms of revenue growth and also profitability. But there are lots of endgame risks remaining, particularly if bond markets decide to revolt. We are talking still of a world where policy-driven reflation is supportive for equities and also real assets. I haven't mentioned gold. One of the things we've been very bullish on over the last 12 months or so is gold. And I think gold and precious metals more broadly are certainly viewed as a good hedge against currency debasement. And also a world, I think, where budget deficits and what I call fiscal dominance continues to sort of impact the bond market. And then, the equity markets, as we've already said, we think will continue to broaden out both by region and sector. And that will be a happier hunting ground for a better diversified, globally allocated equity portfolio. Next slide, please. And in terms of the key investment views, they really follow from the conversation we've had already. We've got a moderate underweight against the global market to the US. We still think earnings delivery will be strong, and we think the artificial intelligence capex cycle has got further to run. But we do view the US dollar as a potential risk. And also, if we are wrong and equities do correct, I think the biggest correction will find its expression in the most highly rated US equities. The UK, we think it's cheap, but we also think it's cheap for a reason. So we think it's worth having a reasonably sensible index weight there. Europe x the UK, we like it based on aggressive German-led fiscal policy stimulus. And we also think there's scope for the central bank to cut rates in a way the market doesn't expect. So out of consensus view could certainly be positive this year. Japan and Asia Pacific, again, positive there, relatively favorable growth dynamic, and also a lot of shareholder-friendly governance reforms are spreading regionally as well. And there's been a pretty eye-catching supplementary budget in Japan, which I think has caused the market to be optimistic in terms of domestic corporate earnings delivery, with the weak yen supportive of international earnings delivery. But we are cognizant clearly of a bond market revolt if participants believe that the Bank of Japan has become a little bit too easy on the monetary policy against the backdrop of sticky inflation and a big fiscal deficit. A view we've also maintained over the last year or so since I've been here is to be bullish precious metals, particularly gold. And that's really led by prospects for US-led currency debasement. And I think a dovish new Fed chair when announced as well, who will keep policy on the easy side. And then in terms of bonds, we quite like bonds out to 7-8 years. We think that there's scope for interest rate cuts to boost their performance. Beyond that, there's a little bit of concern about sustainability of public finances globally, and I think the UK is not immune to that. So for the time being, we're favouring a bullish view on sort of short-dated bonds in the UK. And then property and infrastructure, they do tend to be quite driven by long-term real interest rates. And we think for the time being, they look cheap, but we would need the long-term real rate in the UK to decisively turn lower. And for the time being, there's no evidence that's going to happen. But we do think this is a year of reasonable returns. Where a properly diversified portfolio by sector and region will generally deliver returns at least consistent, if not slightly above the long-term average. And I think I'll leave it there, mindful that we haven't got a lot of time left, and I don't want to take up all your afternoon as well. Maybe we could throw it open to questions.
Right, John. Yes, so we had some questions that came in before. So conscious, having listened to that some of these you might have answered in part or more. But perhaps if I pose them to you, and if there's anything further you want to add, then please feel free to do so. So the first one was, are equities overvalued versus fundamentals, and how much concern is there on the risk of significant correction?
So, yeah, I mean, if we looked at the first couple of slides I discussed, on a 10-year view, I think certainly in the US, you would expect maybe that returns outside of that country could be a bit better. But in terms of where we are in terms of this particular cycle of equity performance, I don't think you can say that we're in a 1999 style scenario. I think the cash flow position of the corporate sector is pretty good. I also think that the policy we're going to get from the Federal Reserve this year, which is going to be on the easy side, I think will also support higher valuations. When you get lower interest rates, you tend to get higher valuations as well. I think the capex cycle has been broadly financed by internally generated cash rather than the kind of borrowing that we saw at the end of the 90s as well. And I think that, putting all that together, it makes me think that this particular cycle has got further to run. I mean, what could certainly cause things to correct more aggressively would be a policy error, which caused long-term interest rates in the US to spike a lot higher. And then that would also in turn increase the discount rate you apply to some of the most highly rated stocks' future earnings, and that would cause valuations to fall. But our sense is that with Scott Bessent at the helm in the Treasury in the US, I think they're very cognizant of that, and they're going to try their best to make sure that policy remains a supportive backdrop for responsible risk-taking ahead of the November 2026 midterm elections, which is obviously Donald Trump's key focus here.
Super, thanks for that. Again, a slightly more different approach. How do you approach the stock market in an era of high valuations?
I think you just have to focus on what the drivers of markets are, and I think you'll be pretty cognizant that the 7 bullet points, if you like, in terms of the scorecard, don't mention valuations. Valuation tends to have a bigger impact once you get sort of 4, 5, 6, 7 years down the track. So, the key drivers that we've identified are things like global liquidity, central bank policy, fiscal policy thrust, economic growth, inflation, corporate earnings delivery, and positioning and sentiment. Now, if you look at those, taking 6 month to 2 to 3 year view, that gives you a better signal, I believe, than worrying about, are we 1.5 or 2 standard deviations higher than the 20-year median, for example. So I'm not saying valuations don't matter, but over a more active time horizon from an asset allocation perspective, you've got to be careful about attaching too much weight to those. And of course, valuations do change. I mean, the highest valued companies are those companies which are throwing off the highest amount of cash. So today's valuation could well be a lot lower in 2 to 3 years' time when corporate earnings delivery kicks in and makes those price earnings multiples less demanding.
Lovely, fantastic. There's a couple of questions left. Is there any incoming government legislation that will regulate cryptocurrency usage?
I'm only really aware of an overview or a kind of a whole market review that's taking place at the moment. And I think that certainly before the October 2027 deadline, the FCA will be responsible for regulating crypto. So that's my understanding. I think between now and then, it's very much to do with, are these going to be able to be brought into ISAs more broadly? At the moment, there are questions around that, what type of ISA it could be. But the key shift, I think, in terms of regulation will take place by Q4 of 27 when the FCA will take responsibility for the broad market.
Okay, a final question. Obviously, you've shown us some really interesting charts during the course of the presentation, but are levels of unpredictability for markets higher now, do you think?
It's a great question. There are things I look at. I mean, if you'd given me about 3 hours, I could have put another 50 slides together. I mean, there are things like, global economic policy uncertainty indices. There are people out there, God knows what they do all day, but they track these things. And I can tell you that, global economic policy uncertainty is very high. Now, that's good and bad. It's bad if you haven't got any idea what's happening, because you can't really, respond to the environment. It's good if you do, because it means other people don't. So if I take, the view that policy now drives markets and the economy rather than the opposite, and I have a particular view on policy, that gives me an edge over the broad market. So that's the way I tend to view it. I mean, what you'd find quite interesting is up until this week, when obviously we had this whole, blow up in terms of geopolitics around Greenland, implied volatility, and I would take that to mean, certainty or uncertainty, implied volatility in bond markets and equity markets has been very low. So the options market hasn't really been pricing in, a big range of potential moves. And I think that's possibly a sign of complacency as well. But, I don't think markets are any more or less uncertain than they ever were. Only because I think that, our 7-point sort of structure gives us a little bit of signal here in terms of where we think markets are going.
Wonderful. Thank you, John. I have to say that's been a really insightful and pacey overview. And clearly, there's lots more to say had we got more time as well. But just to invite you and Isabel back, because we've got just a couple of more minutes before we're due to finish, just for any final comments, really, from you both to our audience today.
Well, I'd just like to thank people for giving up their lunchtime to listen to me, you know, and I welcome the opportunity to share some thoughts, and happy to do this kind of thing as and when. So thank you very much.
Yeah, just reiterating what John says, really. We're always very happy to give inputs if any of the members have got any questions that they want answered around stock markets or investments generally. We have a great resource in John and his team, and also in our wealth planning colleagues as well, who can give insights if it's something we can't help with. But yeah, very much on hand, always looking for ideas to collaborate further as well. So if there are subjects that any of the listeners online want to know more about, then please do get in touch with us, and we'll look to incorporate those into the plans for the year ahead.